Hi everyone, this is Rick Miller again talking about triple screen methods, investment and trading strategies. I'm going to spend the next few minutes describing my favorite strategy, selling deep out of the money puts for income. It's a conservative strategy designed to give one a consistent return on a pile of money, something that you're not going to find with many other vehicles today. Let's say you have $1 million saved that you hope can provide income for the rest of your life. As I speak, you could buy a 1 year CD that yields 1.1%. That vehicle would provide you $11,000 to live on for a year. And not many of us could live off of just that interest. So what happens? You start to eat your capital, and before you know it, it's all gone. That's why I've combined the TSM stock picking based on stock fundamentals and value with an option approach that will provide conservatively a 10% plus return on your pile of cash, or here $100,000 to $150,000 a year on your $1 million. In this presentation, I'll explain the strategy and its metrics, annual yield and percent downside protection, and show you how to calculate them. Further, I'll show you how I personally select the ones I trade. In later videos, I'll discuss ways to minimize the loss when the trade goes bad, which occurs about 5% of the time. So let's get started with just what is a put. Well, a put is one of two types of options, and they are available on nearly all TSM stocks and trade just like the stocks themselves do. When you sell when you sell a put, a contract usually on 100 shares, you give the right to the buyer to buy to you give the buyer the right but not the obligation to put his shares to you at the put strike price. And he or she can do this at any time up until that option's expiration date. In effect, you become an insurance policy for his stock blowing up. And for that, he pays you a premium. The put buyer's actions are very similar to his buying insurance for his home, where he pays a premium for protection from it burning down. The strike is the insured price of the home, and the expiration date is the life of the policy. Think of my short put strategy as you becoming an insurance company. My rules of thumb for the short put trade: one, I use puts for TSM stocks, which have both good fundamentals and good value remaining, to ensure lots of institutional support as a safety net. Two, I only sell puts that have 30 days or fewer before their expiration to minimize my risk exposure. Three, finally, I expect at least a 10% annualized return, though often I get much more than that. Quality underlying stocks, risk control, and a good return on my pile of money. So how do I find specific puts that I'm looking for? Good question. I use a powerful options screening tool. First, I provided a listing of all the TSM stocks of the week and the expiration month that I'm interested in, always what's called the front month. In real time, it then gathers data on all the available puts for these stocks and rank orders them by their risk control measure, something that I call percent downside protection and the screen calls percent break even. Expressed as a percentage of price loss, it tells me exactly how much the underlying stock for a particular put can fall before I start to experience any loss. Here's an example of the screen that I ran the end of the day last Friday on 5/30/14. Let's spend a little time talking about the various columns of information, what they mean, and which ones I consider important. Note I provide this screen every evening in the TSM daily report, and I email specific put plays that I've just made during the day. The first two columns identify the underlying TSM stock involved, and its end of the day price with change from the prior day. Cena was the top stock on the list Friday. The third column identifies a particular put for Cena, one of many that it has. Specifically, it's a $60 put expiring on the third Saturday in June. That's in 22 days from now. Note, selling this put, called writing the put in the option world, would obligate me to buy Cena shares, 100 shares per contract, at $60 a share anytime the seller wished to sell them to me over the next 22 days. And why would the owner of the put contract want to sell his shares to me or put his shares to me? One reason only: his shares have fallen below $60 during that time. We protect ourselves from that situation by dealing exclusively with TSM stocks characterized by strong fundamentals and by limiting our exposure to 22 days. But even so, about 5% of the time this will happen, and we'll get the shares put to us that we'll have to deal with in our stop loss strategy, but that's a subject for another video. The next two columns show the put option premium spread and its bid price. The first is a measure of the put's liquidity. I limit the screen to finding those puts where this spread is 25 cents or less. And the second is a minimum premium that I would expect to take in when this screen was run. I always get, or try to get, the mid price between the bid and ask values. Here the ask price would be the 50 cents plus an additional 50 cents in the spread, 15 cents in the spread. The next six columns deal with this put specifics. Delta tells me how much the premium will change when the underlying stock goes up $1. For example, Cena goes up $1 on Monday, I could expect the 50-cent premium to drop by 11 cents. Delta is also approximately the probability that Cena shares will finish below a $60 price over the next 22 days. An approximate 11% chance here. The exact probability, calculated from a number of factors that I won't go into here, is 87.8% chance that Cena shares will finish above $60, and I will just keep the premium. I prefer delta to fall below 0.15. Note too that these probability estimates do not consider technical factors. For example, where areas of support and resistance lie. Technical factors, I believe, are the reason that less than 5% of these get put to me, even when the delta would predict more than that would be put to me. Implied volatility is an annualized measure of Cena's future price variation expected by the option market maker. It's directly related to the puts premium. That is, the greater the volatility, the greater the premium for me. The important thing is how this future volatility relates to Cena's past historical volatility. The next to last column, the ratio IV to HV, shows that ratio. For example, here at 0.95, the future volatility is expected to be slightly less than its historic volatility over the past 50 days. Note, I would prefer this ratio to be well above 1 because that indicates the puts premium is rich relative to its historic volatility. Note too, in periods of rising stock prices like we're experiencing in the market today, the implied volatility for puts, hence their premiums, lessens. The implied volatility range shows how the current volatility relates to the range of volatility this option has seen over its life. Here it's at the 18% level. Its volatility has been higher during its life 82% of the time. Obviously, we would prefer this number to be greater than 50% because that would indicate again that the option was rich in premium. Further, if it were greater than 50%, you might expect the law of reversion to mean would favor the implied volatility dropping. Hence, its premium dropping, and that's always a good thing when you've sold the option. If this 50-cent premium drops to 5 cents, for example, I would be inclined to buy back the put, close the position, and look to open another position that month with richer premiums. The current option volume is a number of this options contracts that have been traded today. And the open interest is the total number of this options contracts that are currently open, not necessarily traded today, but open. Both are measures of the options liquidity. While we're talking about option characteristics, let's talk about theta, the last column. It's the change expected in the option premium due to the passage of 1 day's time. Remember, options are wasting assets, which lose their value every day, even if nothing else changes. For example, with CINA, I can expect its 50-cent premium to drop by 2 times 3.15 cents by Monday morning when 2 days will have passed. There's an earnings date provided with the number of days before that date is reached in parentheses, because that day is likely to move the underlying stock price and option premium. So you need to be aware if it's coming up in the next 22 days. Often I will write a put intentionally to include an earnings report because the approach of an earnings release typically inflates the options premium. But when I do, I always insist on a good downside protection. The final three factors are the most important to me, showstoppers, if you will. Two yield measures and a percent break even, or what I call percent downside protection. The percent naked yield is the yield I would receive over the 22 days, considering the premium relative to the amount of money that would be set aside in my account until this option contract was resolved. It's assumed that you will have to set aside the strike price times the number of shares involved, 100 shares per contract. For example, if I sold one contract of CINA puts, I would have to set aside 100 times $60 per share minus 15 cents per share premium, or $5,950. The result would then be $50 earned to the $5,950 held in my account, which would equal a 0.84% return. A little different than the 0.8% stated in the table because they did not correct the $6,000 set aside for the option premium received. These estimates are what you would be required to hold for an IRA account. A typical equity account, on the other hand, would require less money be set aside in your account, hence give an even better return. The annual return is simply the return you would expect if you made this same investment every 22 days for a year. Finally, the percent break even is simply the percentage that CINA's price must fall before I, as the put seller, would start losing money. Along with the chart characteristics, yield, and delta, this percentage is the most important factor to me. It's the basis for which all these options are ranked. Having said all of this about CINA, the put that I choose to write was the second one on the list, EMES, because I liked its fundamental and chart better. EMES fundamentals, which I've shown on the pull-up on the left. After running the option screen, I look at fundamentals of the stocks that I'm considering. Note each evening I also provide this fundamental data for the puts under consideration. EMES fundamentals are shown here. It holds membership this week in 8 of my screens. The set of 4 numbers represented by dashes tells me that 2 of the screens are vector best, 3 are IBD, 1 is from a variety of other sources, here Navalier, and finally 2 are from Zacks. The particular screens are listed in this next pull-up. TSM ranks each of its stocks on a 1 to 6 scale. The higher, the better. Particular criteria can be found at the TSM site. Zacks ranks stocks on a 1 to 5 scale, with the lower numbers, the better. Zacks rankings are proprietary based on a number of earnings criteria. They are simply the best ranking of stocks available. The target price is based on earnings valuation methodology. Of course, I would prefer my put strike price to be lower than this target price, because ultimately I could be owning this stock at that price. PEG ratios, price to earnings growth, or another way of looking at it, price divided by the product of earnings times earnings growth, are measures of value. And the lower the value, the better. Lower their value, the better. The value at the stock's present price, I use two PEG ratios. The first based on this year's earnings growth, and the second based on the following year's estimate of earnings. For me, important fundamentals in their order of importance are Zacks rank, which can be a 3 if the market cap is greater than 10 billion. PEG ratios, target price relative to strike price, price to sales ratio, and which source have them ranked in their screens. Okay, the EMES chart. Let's now spend a few minutes looking at this chart. I like the fact that it has been steadily moving higher with good support from its 20-day and 50-day moving averages over the last 6 months or so. I wrote the $85 put, shown by the white horizontal line on the chart, for an 80 cents per share premium, and guaranteed that over the next 20 days I would buy 100 shares of EMES per contract for $85 a piece. Note the 20-day moving average support right at that level. The percent downside protection is calculated as the difference between the current price and the put strike price plus the per share premium. Here, the current price is $95, the strike price is $85, and the premium is 80 cents. EMES shares would have to fall by $10.80 over the next 22 days before I would be required to take the shares in a lose money position. That's 11.4% relative to the current price. The year yield again is a simple calculation. Here it's 15.8% annualized. My last slide shows the range of front month puts available for EMES. Their strike prices run from $75 to $115, and their premium increases steadily. Remember too that the current price is $95, so a strike price above that would already be in the money and have a high probability, high delta, of finishing there. The last two columns tell the story. As we go to higher strike prices, yield increases, but the downside protection falls off. I'm looking for a combination of acceptable yield with good downside protection. The combination circled is the one I chose to write. Well, there it is, the deep, out of the money short put strategy, a strategy that consistently produces a good rate of return on your pile of money. I have done several hundred of these, many of which are tracked on the TSM site. Next time, we'll talk about a stop loss strategy that'll turn most of these 5% losers into winners. Thanks very much for listening.